morning, everyone. I'm Todd Davis with FreightWaves. It's a pleasure to be here with you and at the request of the Keller organization to be invited to participate in this customer summit. I'd like to talk to you about transportation market trends that we're seeing in the marketplace right now. For those of you who are not familiar with FreightWaves, we're a data analytics and media company. We've been in business for roughly 3.5 years, and we gained quite a following in that time period based on the scope, breadth, and extent quality of our data analytics and media content that we bring to the marketplace. I'm with our customer success and brokerage teams, work on the customer success side, and I also have responsibility for both our carrier and broker benchmarking offerings. We operate our carrier benchmarking offering in conjunction with the Truckload Carriers Association through their TCA profitability program. So we'll surface up a little bit of data from that particular program here a little bit deeper in the presentation. With that being said, we'll move into the main topic here, which is kind of where we've been in 2020, a year quite unlike any other in the industry, obviously, to say the least. What I want to show you with this first slide, this is some high-level sonar data. This is a graph view of outbound tender rejection rates in the United States. These are rolled up at an aggregate USA level. The y-axis numerals represent actual percentages. These are not, this is actually a percentage of loads rejected, from loads that were tendered. And the white line is the year 2020. You see the run up with the COVID spike that we have here and then the drop off. The other 2 years, the green line is 2019, the rejection rates for 2019. You can see how they kind of trended along the bottom. They never really got, much above 10%, except at the tail end of 2018 going into 2019, and then in the year 2018, the rejection rates were quite elevated. Most folks on the call will probably recall, the second half of 2017 and the first half of 2018 as being very, very high demand times, high load volumes, high rejection rates, constrained capacity, things along those lines. Kind of tapered off in the second half of 2018, and then 2019, was a very muted year. And not really as heavy in terms of demand and rejections as the prior time period. This year, what we've seen, and this year kind of started off like 2019. It was just going to be almost like a continuation, but then you had COVID hit in the United States with a vengeance. You had definitely a rush in demand from a volume perspective, getting CPG and food and beverage into the supply chains to kind of get it out to the end retailers for folks who were, going home, quarantining at home, businesses were shutting down, things along those lines. So that load volume hit the market. The rejection rate basically mirrored that. It shot up in March, and then it started to come back down after, there's a bit of a COVID, post-COVID hangover, as it were. And it definitely came down as industry, all non-essential industry and businesses, basically closed and went into self-quarantine. So, definitely a snapback and a contraction, and then long about maybe mid-May, kind of in the June timeframe, as some businesses started to open back up, and then just essential business, started to catch up with orders, replenishment orders, inventory replenishment orders that were starting to take place from retailers, that had kind of got wiped out of consumables and critical supplies. Volumes started to trend back up again, and then correspondingly, what we saw was tender rejections, started to rise again as well. And they kind of continued to grow throughout that time period, through the Memorial Day, the 4th of July, the Labor Day holidays. They've still just continued to march right up to the point now where roughly, 1 in 4 loads, this is a percentage, so roughly 1 in 4 loads in the United States is being rejected. This isn't at an aggregate level. It's taking into consideration dry van, refrigerated activity, but definitely getting back up there. Since our indices started on March 1st, 2018, we're seeing rejection rates kind of be at near all-time highs. So, definitely that's out in the marketplace right now. probably this is going to continue to some degree as you have the kind of the dual track restocking of inventories just for consumables and food and beverage and things along those lines for daily, household, running some households and things along those lines. But then also too, there's the parallel track of volumes out there that are coming in for fourth quarter peak season. So you've got those two parallel tracks going right now. At some point in time, we'll probably see a taper as we get just a little bit deeper into the fourth quarter. Probably a little bit more seasonal cyclicality will start to take place, and that we'll see a moderation in the trend line. So that's on the the rejection rates. Areas where we're certainly seeing rejection rates. This is a map view of Sonar, and it's showing 135 different markets. And this is a view of where markets are most pronounced based on kind of the height and aspect of the data. So you're seeing rejections most pronounced in the major volume markets right now. That's going to be LA, Long Beach, Riverside, the Inland Empire, with the port throughput there, Harrisburg, Middletown, Reading, PA, kind of the distribution nodes up there that kind of feed the Northeast, Atlanta, Memphis, St. Louis, Chicago, traditional outbound markets where there's manufacturing and the proximity to end consumption markets, the Ohio Valley markets, the strong manufacturing base up there as well. Also, the port areas, Newark, New Jersey, Savannah, the East Coast ports are seeing a surge in imports, as well as the West Coast ports as well. So, throughput coming through there, not enough capacity on the roads to be able to handle that volume demand. So, boom, here go rejection rates. So they're definitely up. In terms of like the maritime aspect of it, import shipments have had some of their biggest months on record in the last couple of years. Ocean shipping rates for 40-foot containers coming into the United States on the trades from Pacific inbound to North America or from Europe inbound to North America are at some all-time highs right now. So that appears to continue. That we think that trend line is going to continue, and it will. I think we'll see just a continuation of these areas being kind of the hot market where rejections are up. Shippers are possibly going to be in distress based on how they're sourcing capacity to cover their loads, and we think this is will be in effect for the next little bit. How all this plays for the carriers and for folks down on the ground, where the rubber meets the road, actually getting loads moved is, obviously there's been a big run up in spot market rates as a result of these increased volumes and these increased rejections. This is a view of the truckstop.com 7-day dry van rate per mile for the USA. That's the white line that you see on the graph. And then overlaid with that, we've got this same data, but for some specific lanes, not aggregated at the USA level, but on some specific heavy volume lanes. What we saw was starting, around March as the COVID spike, started to manifest itself in terms of volumes and rejections. Spot rates tend to follow rejections. They're very, very tightly correlated. So you saw spot rates start to go up. National average for the truck stop van rate at that time was somewhere around the 225 a mile. This is inclusive of fuel. This is just a spot rate from the truck stop folks. And then there was that post-COVID hangover when industry shut down, non-essential industry shut down. And then as things started to open back up, and then when China opened up earlier, they kind of got back to market probably first before anyone else. And then here came, the inputs through the ports. Then volume demand started to move up. Capacity was still constrained. So here went rejections, and then spot rates followed, very, very closely correlated in that regard. So now average is roughly about 276, again, inclusive of fuel. That's about a 22.5% increase off of the March COVID peak that we saw right here. The other lanes that you see right here, the green line is the LA to Dallas lane. The orange line is the LA to Seattle. Purple line is Chicago to Atlanta, and the yellow line is the Atlanta to Philadelphia lane again. Put those in just to kind of show they're all kind of moving the same direction, albeit at different speeds, at different paces. But those are pretty indicative of volume lanes that are out there that can be used as indicators, for proxies for other pricing. Certainly will have a knock-on effect with contract rates. Spot, as spot moves, contract ultimately moves as well, depending on the amount of increase or decrease in the spot rate. At these levels, there certainly are impacts on contract rates. That's certainly what we're hearing through the channel checks that we have. Those improved rates, improved volumes, improved choice options that are out there for carriers have certainly helped improve carrier performance over recent timeframes. This is a view from our carrier benchmarking information. It is lagged due to antitrust concerns. There is a 90-day lag due to antitrust concerns on some of this information, but nonetheless, you can see where the white line is for dry van, the orange line is for refrigerated, and you can see where operating ratios, in 2019 had kind of bounced along. They had been, kind of close to, upper 90s, close to 100 as an aggregated group for the two different mode types. Certainly, some peaks in and around the COVID affected time periods here in the first quarter, early second quarter of 2020, but then with improved volumes and improved utilization opportunities, they've started to come back down. A bit of a blip here, but suffice it to say that the trend line, over this time period has been down for ORs to drop and improve, which has been some welcome news. We certainly see that there is, a brighter outlook for those operators, just based on the increased volumes that are out there right now, and the market improvement in spot rates. It's helping carriers who have kind of weathered some very, very tough times through the COVID time periods, that affected their utilization. So, a bright spot there certainly is welcome news for that particular group. On the utilization front for revenue per driver per week, this is another carrier benchmarking stat from our Sonar data set. This is showing revenue per driver. We also show it at the truck level. I thought it'd be interesting to show it at the driver level. Obviously, some fleets, in order to gain utilization on the equipment over, a 24-hour time period, trucks can be slip seated or pressed into service on multiple shifts throughout the day. The revenue per driver per week, this is for the dry van cohort for company fleet and leased fleet combined, definitely has come back up. It certainly tapered off, obviously, when industry shut down and there was not as much opportunity and choices out there for the carriers, but definitely has jumped back up. The trend line still is continuing to come up there. The increased volumes, tighter capacity, obviously increased spot, cause the rates to rise, and contract rates are going to see upward pressure, or are feeling upward pressure as well. Correspondingly, empty mile percentage for fleets has dropped off based on improved options for carriers to just a lot of volume demand out there. Rejection rates are high, a lot of opportunity for fleets. Empty miles are had shot up, when industry shut down and there wasn't as much volume on the market. Now that has kind of reversed itself, and we see those volume trends just continuing to go up and up and up. The empty mile percentage has definitely kind of come down. So this kind of helps carriers insofar as they're not running uncompensated miles. It definitely helps, their cost picture and their utilization picture as well. This graph is showing the white line is for the dry van cohort and the green line is for refrigerated. Obviously, every graph it's like that I show you, for this year, you see these peaks over here around the March, April timeframe with COVID effects, but then the drop off thereafter. So this is welcome news for fleets and ultimately for brokers and shippers as well. On the road ahead, we'll take a look at some data sets and see this is probably going to be a little bit more of an unusual time period. There's so many variables in play. You've got COVID, you've got national election, you've got market demand out there right now, market demand trends and rejection trends. It's going to be hard to kind of pin this one down, but we'll look at some data that may help everybody just kind of see, kind of what the road ahead is going to look like for carriers, what some of the potential headwinds are going to be that will eventually affect us all on, whatever area we're kind of coming into the marketplace at. So one of the biggest headwinds that we're starting to hear about is turnover is starting to come back up again for fleets. This is a graph of company and leased fleet dry van. That's the blue line, and then refrigerated is the green line. But we are, from the benchmarking statistics, we are starting to see that turnover and starting to rise back up again. There's several things related to that. This is a multifaceted issue for carriers, but one is continues to be demographics. The second, there's some COVID effects out there that are kind of constraining CDL holder supply, and then that's leading to some churn, and it's leading to some issues or some situations where carriers are increasing pay, they're implementing sign-on bonuses and things like that. But the COVID effects have been, and we've heard about this from a number of carriers through channel checks and some other reporting that our team has done. The CDL schools, just based on how that model works, it's in class, in person, and then it's behind the wheel time, and there is some simulation, driving simulation, stuff like that. But mainly it's in person, in class. Due to COVID, the pipeline for those schools, has been constrained significantly. A lot of these schools have not been able to see classes, due to lockdowns and the like, and that certainly has affected kind of the CDL holder pipeline as folks would come through those schools and then graduate with their CDL and kind of get out into the marketplace and start working with carriers. So a constraint there. Some carriers are saying that they feel like for the first half of the year, roughly 100,000 plus. We've actually heard that number go a little higher, so I'll say 100,000 plus CDLs issued, 100,000 plus less CDLs issued year to date than the same time period for the previous year, for 2019. It certainly makes sense. I mean, obviously, if you can't go to get folks into the school because of quarantines and social distancing and that type of thing, there certainly would be an effect in that regard. We're seeing it manifest itself as there's some churn within carriers. Carriers are now starting to go to market with just recently in the last few days, I've seen where carriers are saying, they're putting out information relative to higher pay rates, sign-on bonuses, things along those lines. So they're trying to keep their trucks seated. Reports of carriers having empty and available trucks due to drivers coming off the road because of concerns about COVID. They tested positive. They can't go back out. They've got to quarantine, things along those lines. So, a little bit of a vice right now, it sounds like, for carriers. So this will bear watching to see how this plays out as we move forward. Another potential headwind for carriers that will affect that group and then ultimately affect the brokerage and the shipper community is the hair follicle testing in conjunction with the Drug and Alcohol Clearinghouse that went into effect this past January. Right now, as I understand it, with Drug and Alcohol Clearinghouse, those urinalysis samples that are submitted, that's where they're being kind of kept in a database. Year to date, roughly, I think 24,000 positive tests have been entered. Certainly, as time goes by, that number's probably going to grow, and that will have an effect, I think, on capacity and driver availability. But then another issue that kind of affects this, or that may affect this, is on September 4th, the Department of Health and Human Services released their mandatory guidelines. They released these for comment, actually, regarding hair follicle testing. That had been discussed for many years, it seems like, and if I recall correctly, and finally HHS has kind of dropped those guidelines down for comment. Federal Motor Carrier Safety Administration is considering whether or not ultimately carriers should include the positive hair follicle test that they may be collecting from their applicants or from their driver tests into the Drug and Alcohol Clearinghouse. Suffice it to say, given the higher level of accuracy and precision, and the fact that the hair follicle testing can go back further in time to test an applicant for any type of banned substance. If those were entered into the Drug and Alcohol Clearinghouse, I think certainly it would be logical to conclude that those numbers are probably going to get bigger. Survey research on the part of the driver cohort, the driver populations are that there's not, there's reluctance, obviously, on the part of that group to want to participate in hair follicle testing. So I think there's, again, kind of a vice, for carriers in that regard. Some carriers are going ahead in order to help themselves from like a safety and compliance and insurance standpoint. They're going ahead and paying the extra money, and they're getting the hair follicle test in addition to the urinalysis test. They're doing that to demonstrate to, I guess, probably their insurers and shippers and the community at large. They're taking that step to do that. If these tests ultimately make it into the clearinghouse, and then that starts to have an effect for carriers when they hit that database to see if a person, is going to be qualified or not to be a driver for them, that certainly is going to affect the labor pool. So this one's going to bear watching to see what happens with the comment period, and it's going to bear watching to see what happens with FMCSA if the hair follicle tests are actually going to get included. Another area that probably bears watching is one that probably everyone on this call or participating in this presentation, has had some understanding of, and it relates to insurance for fleets. There's been a lot of talk over the last couple of years about nuclear verdicts and jury verdicts in trucking accident cases that can up to and include bankrupting the carrier or putting them out of business. That still continues to be an issue out there that's hotly debated on several different sides of the topic. I'm not here to say what's right or what's wrong in that regard, other than to say that it's there and it continues to certainly be an issue. There's wide reporting about some big name insurers who have exited the market, constraining the pool of insurance companies that are out there and who are willing to write trucking companies. So I think that's something that's going to bear watching. Insurance as an expense, based on the data that we're looking here from the benchmarking stats for dry van and refrigerated, certainly for the dry van cohort, it has ticked up there a little bit. Certainly something to watch. I think most carriers, they try to get ahead of it. They try to be very, very proactive. They've got good safety programs, good compliance, good risk management protocols, and they try to go on offense, as it were, to demonstrate that they're good, safe, compliant, responsible carriers. That hopefully with their insurers, that's having an effect and helping them in their rates and that type of thing. Another topic that's an area of concern, and this kind of has come up in the last little bit. There was some talk in the U.S. Congress about raising the required carrier insurance minimums from $750,000 up to $2 million. Certainly generated a lot of buzz. That will be something to kind of keep on the radar and see what happens with those conversations. We're close into an election, so who knows what direction that ultimately will go. As we move forward. But again, if you take kind of what's happening with policy premiums, the ability to get coverage from insurers, the rates that they're paying, and then you take this on the other hand in terms of raising those minimums, certainly some cost pressure there for carriers that will bear watching. That ultimately, again, for all of us who are using those assets to move goods, to market, we'll all be kind of in that boat. Another area that I wanted to talk a little bit about, this is one that's not really on the radar right now, but, it typically is one of the big three cost drivers for carriers. It's wages, fuel, and equipment costs. The fuel right now is not much of a headwind for carriers at this particular point in time. It's certainly come down a bit. This is a chart from Sonar showing the spread between rack and retail. But as the economy opens back up, vaccines become available, the economy opens back up, air travel starts to come back online for passenger traffic and things along those lines, in addition to the freighter traffic that's out there, just overall increased economic activity, we may start to see that spread tighten up a little bit. So just wanted to throw that out there that, certainly this situation that we're in right now relative to fuel pricing probably is not going to last, and that this will be something that will need to be monitored as well. Last but not least, the biggest unknown, we'll find out what happens here probably the evening of Tuesday, November 3rd, or maybe some point in time thereafter. But I think that this will have a big effect on, the outcome here will have a big effect on the policy and the regulatory environment, as well as the economic environment. So, I'm not here to prognosticate what's going to happen, other than to say that, it seems like somehow only fitting in the year 2020 with COVID and all the exceptional things that we have all lived through and experienced, that it's going to be kind of capped off by probably a very, very, very contentious election cycle. So this will certainly have an effect. As to what effect it will be hard to say. Nonetheless, it will be impactful for sure. So hope your candidate wins, put it that way. And with that, I'd like to kind of close. I'd like to thank Aaron Keller and the Keller team for inviting me to come and speak with you today. I appreciate the time. Aaron and the team have been great to work with. I wish that group and the attendants a great customer summit. Hopefully, this information has been helpful and been beneficial. This is my contact information. Should you want to reach out to me about any of the information that I've gone over, or you'd like to learn more about FreightWaves, please feel free to give us a call, reach out to me. I'll be more than happy to speak with you and help you out in any way that I can. So with that being said, thanks for your time this morning. Hope everyone has a great rest of the year, and here's looking forward to 2021. Thank you very much.
Aaron, you have some questions?
Yeah, we have one question right now. It's kind of a long one here, so bear with me. FreightWaves is kind of the new kid on the block, moving fast in terms of data and forecasts. This recent COVID event and pickup in the economy is starting to put strains in the supply chain. Your teams have been courting shippers. Recently, your news reporting on the transport industry has been extremely sensational, hyping up capacity shortages and rates. Why have you taken such a sensational approach in commentary and doom and gloom? Why should a shipper give any credibility to you?
Well, I mean, our reportage is based on our contacts in the industry and our data. We think that the data that we see, the scope and breadth of volume data, rejection data, and the other indices, basically speak for themselves. There's no, bias or intent to be sensational. I mean, this year is certainly exceptional insofar as demand levels, capacity being as tight as it was, if not maybe a little bit more, second half of 2017, first half of 2018. And then all of the unique challenges that this year poses. Reporting on incidents such as, like say nuclear verdicts or things along those lines. I mean, that's, straight from the public record in those areas. So again, there's, in my estimation, I mean, I've been in the industry for 24 years and I'm with FreightWaves now kind of on this side of the fence, but I'm not, I've not seen the sensationalism of it. I mean, there's not a mandate, to be that way or to drive traffic in that regard. Is there a particular area that you feel is that has been the case?
This came through on Slido, and it's anonymous, so I'm not sure. They'd have to dig a little deeper.
I'm sorry, I didn't hear that completely or clearly.
Well, this is on Slido, so it's anonymous. So I don't.
Okay. I'm sorry, I didn't. Please feel free to reach out to me. My contact information is at the end of the slide deck. I mean, we certainly want to bring transparency. The goal, the intent with FreightWave was to use data, to bring transparency to all the stakeholders in the marketplace, whether they own assets, they're intermediaries, they're shippers, they're more on the association side, or whatever the case may be, and enable all participants, just based on data. If certainly you see something that is, in your opinion, um, maybe outside the realm of kind of what you're maybe used to reading in other periodicals, or media outlets, things along those lines, definitely, I mean, feel free, please reach out. I mean, we want to serve all stakeholders. We're not here to pick winners or losers, or those types of things. I mean, please let us know. Please let us know what your concerns are. We want to be responsive and address them.
Okay, we do have another question. What can we do as a shipper to hedge against the projected demand and capacity to ensure we move our freight efficiently?
If I heard the question correctly, it kind of maybe stemmed around what can a shipper do in order to secure consistent, reliable capacity at good rates, right? Was that
Yes.
this?
Yes, that is correct.
Okay. Yeah, I would say from my experience, when I was a couple of decades on the asset operation side, is work with your carriers and understand what you can do to be a shipper of choice. Help them as they try to help their drivers, earn a good living and generate a good utilization and get good miles over the week. Just little things that you can do along those lines. And in my opinion, in my experience, and that seems to what really helped us when I was on the other side of the fence with the asset group. Little things, just helping drivers get in and out. Having good in-gate, out-gate processes, trying to be as timely and responsive as your team can be. At your ship sites and your receiving sites. Amenities, Wi-Fi, on the lots, access to facilities. I know right now maybe that might be a little bit difficult with COVID and the need to kind of keep folks socially distant. Look at pay terms. I mean, definitely hold your carriers to account. I'm not saying that everything is completely in the court of the shipper in that regard, but I think that if carriers see shippers um, exhibiting a willingness to kind of really partner with them, that goes a long way. Things along those lines, and then also too, through the RFP type events, work with the carriers to understand what they do and do well, where they give good service. Listen to concerns they might have about changes they might need to make on lanes in order to have better utilization or better margins and those types of things, and maintain the relationship, I guess, maybe in that overall spirit. That was my experience of what we saw really seemed to work and engender stability, which the stability then translates into, consistent capacity, good service, and good value, ultimately for both parties.
Okay, we have another question. I had heard about a futures or hedging market for freight coming in the future. Can you give us an update on that product and how it could work?
Okay, I apologize, everyone. I didn't hear the
Okay.
first part of the question.
I had heard about a futures or hedging market for freight coming in the future. Can you give us an update on that product and how it could work?
We're currently in the process of uh, going to the second iteration of our futures product. I don't know all the details behind it. I'm in our customer success and benchmarking channel. We have some folks that work specifically on the futures piece, looking to kind of broaden and expand that particular offering. I would be more than happy to provide additional information, but I would need to defer to the folks within our organization who are currently working on kind of the version 2.0 of that for specifics.
Thank you, Todd.
Okay, thank you again. If I can be of assistance, please don't hesitate to reach out with the contact information that was at the end of the slide deck. So again, thanks to the Keller team, Aaron, and the team. I appreciate the opportunity to participate. Be well, have a great customer summit, and see you soon.